Hello, everybody. So today I want to talk about four hyper-growth stocks that have been beaten down since the beginning of the year and that I consider to be on sale right now. And this is important to highlight those stocks. No investment advice, of course, but it's important because my portfolio is on fire. Tesla's through the roof. All of the Bitcoin is through the roof. It's annoying. The deals are gone. So where can we still find some deals for the new money that is coming in for my DCA? You know, I buy stocks most days, frankly. It's the monthly DCA, and that's what I think a lot of us do. So where do I direct some of those funds for my investment? Because clearly now Tesla's gone, and many stocks are expensive. Let's get started. Let's talk about a stock that I have been buying a lot recently. Celsius Holdings. It's a miracle in my view, because I was buying this stock more expensive 6 months, 9 months ago. This stock was a leader back then. In my view, it is still an absolute leader in the energy drink space in the United States. It is everywhere. It is flying off the shelves. I go to Costco quite a bit. I see those pallets. I see people picking up those giant 30 packs of Celsius, $25 a pop. I see it all the time. Gas stations. This is a product that it's had a problem with the distributor, right? The distributor Pepsi was greedy, and they bought from Celsius even more cases than what they thought was going to be. And this is why the stock is down, because they need to right-size, quote-unquote. Pepsi needs to right-size its inventory. It's got, last time I covered it, I think it had something like 12 or 13 million extra cases that they need to go through, which is why we have a few quarters where the growth is, I guess, not nearly as good as the 50+% that this company was growing at. But as far as we're concerned, as far as the sell-through at the stores, is still happening. I see it daily down here in Texas. I'm sure the European countries where this Celsius has gotten into, for example, the United Kingdom, I'm sure you can see an important sell-through. And I want to talk about the opportunity that this stock has. To me, the stock is almost down 50% from the all-time high. The sales growth will show again into the numbers as soon as Pepsi is done through its inventory overstock. They are the number three energy drink in the United States. In my view, they could be the next Monster, is how I describe Celsius. I think they could easily outpace Monsters and or Red Bull in sales in the next few years, because this drink is the cool drink. It is the Gen Z drink. It is the drink of people going to the gym. It is a drink that is heavily adopted by women, by people of all sorts of ages. It is a drink that does not have marketing that is about extreme sports, and therefore it has a larger addressable market because of that. They also promote the health component of the drink. Now, this is up to the appreciation of the viewer here. You decide, but they have their own scientific studies that they've done and showing how if someone drinks a Celsius before working out, they have a lot of good outcomes. Some scientific studies that they publish that you can read. And of course, some of it would make sense, right? Like if you had vitamins and stuff, it's kind of this trend of these powders that you see more and more where they add a bunch of vitamins in addition to your regular coffee powder or green powder or whatever. This is part of that trend, very popular among Gen Z. And the sales, if you can see the growth, despite the fact that they've had that little issue with the inventory at Pepsi, this is the numbers as of Q4 2024. You can see we still have a doubling of that. So the growth, in my view, is unabated. This is as of Q4 2024. Q4 will likely be double that, right? So you can expect that bar to keep showing that growth. I don't think we've quite hit the law of large numbers yet for Celsius. And the reason for that is because they have just started their global expansion obviously lots of info about them going into the UK and Canada, but they are going to other big markets like Australia pretty soon, right? A consumer that may be excited to receive this American product, and I can tell you firsthand from my connections to France, obviously with my accent, I can tell you that people are pretty excited in France about the product coming in the second half of 2024. And believe me, anything that's American over there, it tends to do very well. So, it's, and then there's the whole of Europe. Europe is what, almost 50% more people in Europe than in the US. So this market is tremendous. And I remember, I go back to France twice a year. Whenever I go back, I go to a store. I see Monster. I see Red Bull. There's a spot there. There's a spot for this brand there. And in my view, they will do very well. And they've partnered with a Japanese distributor for this market. So we'll see how well they'll do. So this is a long-term play. This is a stock that I look forward to own for the next 10 years. And I think right now the entry point, point is excellent. And I've been adding at this level. I've been adding almost every day for the past few days now, and the past few weeks actually a little bit. And this is a stock that I love right now. And I actually just had a Celsius as I register this video, which seems to be a theme. Whenever you talk about Celsius, you drink a Celsius. Anyways, whatever. Let me move to stock number 2. Stock number 2 is Dlocal. So Dlocal, I've bought a while back. It's always been a very small position for me because it is higher risk, because it is, in my view, higher on the risk curve. And the reason for that is because of the doubt that keeps being cast on this company by a lot of short sellers. This company is one of the prime attacks of short seller. And if you've owned this stock, it's been an annoying one to own. But whenever I go back to the numbers, I keep being compelled by the numbers. If you can see, for example, the total payment volume, the TPV, and payment companies tend to report that. The TPV guided 2024, they guide for a TPV of plus 44% of the TPV that they guide. Now, unfortunately, they must have had to do a lot of concession to gain customers, because if you look at the gross profit, and they communicate on gross profit, not revenue, if you look at the gross profit for a DLO, it's only forecast to grow between 1 and 9%. I'm taking the midpoint of their guidance for gross profit. So there's been a deceleration in the growth in the profitability of a company, but there hasn't been a deceleration in the adoption of the payment systems of Dlocal. As a reminder, Dlocal is a specialist of online payments in emerging markets. They specialize in helping a lot of Latin America, some parts of Africa, paying for all of these digital services that we all have now come to love, like, I don't know, Microsoft 365 or whatever. And they facilitate those payments with local payment system. That is the business model. The growth is there. Commercial concessions likely had to be made, but that it's not a drop, right? That slowdown in gross profit, in my view, over the long run, will likely go back up. So higher on the risk curve, definitely. A slowdown, definitely, right? And we were growing close to 50%. We're now growing at something like 1 to 9%. Analysts do not buy that. Analysts are still thinking there will be a revenue growth for this company of 33%. But if you're a long-term investor, you have to make a decision over a place you're going where you can't see. We can't know where a company like Dlocal will be in 10 years. But in my view, the transaction volume is going up, and that's what matters to me. And one question that I think one has to ask themselves when they look at a company like this, which is profitable, as you can see, is for a deceleration in the growth, and let's say a deceleration from 1 to 9%, you're moving from 50% from 1 to 9%, is that worth a drop of 53% in the stock price? Is that drop a stock price being so beat up? Well, it's not the first time the stock has exhibited these large moves. I just think this is a stock that the market does not know how to price, but eventually the market is a weighing machine, and if they keep growing transaction volume at a 40 to 50% clip for the next few years, in my view, the market will catch up. So very small position for me. I haven't been adding. If I were considering to add to this position, I would be looking at leaps personally, especially after such an important drop. Let me know what you think of this company, if you think it would be worthy to do a full deep dive on this company again, as I have before on this channel. Moving on to a third company. This is a channel favorite, and this is a big position for me, perhaps a little too big, but that's okay. It's a big position for me. This is a company that I like to call a cash machine. Someone in the comment section the last time I called it a cash machine was like, I'm weird or something for calling it a cash machine. But it is a cash machine. It's a company that's in the cash piling business. They've been piling a lot of cash. They have 50% EBITDA margin, right? You're getting close to a little lower, but close to a Visa or a MasterCard on this one. And the growth has stalled. This was a business that was growing at 30 to 40%. And much to my disappointment, it is now growing at 14%. But I think the growth will come back because this is, again, I'm a long-term investor. I don't invest for next year. I invest for the next decade, or at the very least the next 5 years. And clearly, the Brazilian market has been a little bit cyclical, right? They dropped the rates sooner than the USA. They are going through a recession sooner than the USA. And so that can explain a lot of that drop in the payments volume. But yet, when I look at StoneCo and when I look at the long-term plan, remember last year, around this time, they gave us the 5-year guidance last year until 2027. They described their business as a payment system for medium, small businesses, for medium and small businesses. And today they're going after banking for small business and payment for micro business. Keep in mind that is the market of Mercado Libre. So they're competing against Mercado Libre for micro businesses. And then they gave us a vision of what they want to be in 2027. In 2027, they want to have all of these cases done. So they want to expand software to small business, right? Kind of being the ERP for small business. They want to start expanding credit, which is why the market is spooked, which is why the market is scared that they're going to do a mistake again with their collateral system on credit, and they want to expand banking. So you see, they want to have more products in more segment. They have a long-term 5-year plan, and I invest for the long term, right? I don't invest for the short term. The way I describe StoneCo, STNE, as they say in Brazil, I describe it as the square of Brazil. And, you know, the founder of this company, guy from Stanford, he was quite inspirational, learned a lot from the way the US did payments and from the way Square did it, went back to his home country and did that to Brazil. This is a stock that is both owned actually by Cathie Wood and Warren Buffett, which is still quite interesting. And, you know, of course, the stock is down. Well, deceleration probably has a little bit to do with the fact why they're down 35%, right? A little deceleration in the growth, but not in net income, right? Their income and their EBIT, and you know, in this channel, I care about EBIT as a proxy for cash flow more than net income, but both of them are growing at a 50% year-over-year clip. So the operating leverage for a company like StoneCo is really kicking in, and they are launching the banking system. This is spooking the market. They're expanding banking deposits. Client deposits at their banking offering are up 65%, and they are especially re-entering the credit market, which is what I think has the market spooked. But they had a bad experience once. I think they fixed the issue that they had with that experience, and they want to start credit because, remember, one of the assumptions in these businesses, one of the assumptions in banking is that every small business wants to borrow money if the cost of money is cheap enough. If you offer cheap enough credit, you're going to be able to grow as much as you want depending on the risk you want to take. So it's all a matter of your underwriting, right? If you're loose with the underwriting, you can show outstanding revenue growth because you're going to be lending money at a bunch of people that should not be borrowing money. And so credit is about finding that right balance between the defaults on the money lended and between the growth. But oftentimes credit is a way for these companies, this would be true, say, for SoFi too, it's a way for these companies to really reignite the revenue growth, because by default, most people, most business owners want to borrow money if it's cheap enough. And the key is to not lend to people who are likely to not repay. So it's an art in and out of itself. We're relaunching that, but you can see the numbers right now, they're not too meaningful. They are small numbers, and we will see how they do. Their guidance is excellent. As far as profits go, at least, their guidance is excellent. They are guiding a 70% increase in adjusted net income. And so this is a company which to me is quite interesting. I own it for the long run. I'm actually flat-ish on the stock because I was lucky to buy it cheaper than this. But we'll see. We'll see how it goes in the future. It's a long-term hold for me. Not doing anything, not adding, not selling, because it's a big position already, but I'm confident, and I'll talk about it. I'll talk about it in 2027. We'll see in 27 if I was right or wrong. We'll see. And the last stock, which is a stock that I've been following, but I don't own. I don't own this stock, but I've been following it for more than a year now, and it is Xometry. How did I find Xometry, by the way? How did I end up on Xometry? Well, I screen network stocks, network effects stocks, two-sided seller and buyer marketplaces. And why do I do that? Why do I like those marketplaces? Because once you establish those marketplaces, there is no going back. There is no competition. It's very tough to be unseated by a competitor once you have the leading network, right? That's why we still use the telephone. That's why some people still use the fax machine. And that's why slowly the whole world, everybody's speaking English. That's the power of network effects. On this channel, I'm not the biggest fan of moats. I think moats are mostly a misconception from 1965 that we owe to Michael Porter and his book Competitive Strategy. I think moat is less important than a lot of businesses and investors want to make it to be. It's a little too legacy to Warren Buffett-ish way of thinking, but there are a few moats, right, in which I really believe in. One of them is network effects, right? Network effects, in my view, I mean, the iPhone store, the iTunes store, the iPhone store. How do you unseat that, right? How do you unseat the Play Store on Google, right? How do you do that? How do you unseat YouTube or Spotify? Could anybody compete against YouTube or Spotify? It's very, very tough. That is the power of platforms. Platforms, once they are a leader in the marketplace, they're very tough to unseat. That's why I like them very much. And in the case of Xometry, I like it very much because, first of all, their penetration in the industry is very small at only 1%. And I'm not saying this is a business that could get 100% of that market, but just assume if they just were to get 30% of that market, well, that's a 30x in the size, right? So that would be tremendous, built in that stock price. They could get higher, right? Some networks get much higher penetration. That's point number one. Point number two is you can see the company was started in 2016, and each cohort spends more money year after year. So the 2016 cohort started with 3.3 million. They're now at 42 million. And you can see this is a pattern that we find for every single cohort. They all keep spending more year after year. This is the classic chart. It's usually graphed as a different form of chart, but this is they have it at a table. It's usually a chart, but it is the classic cohort chart with each cohort spending more and more money and sticking with the platform. What do they do, by the way? They're a platform. I didn't even tell you what they do. What do they do? Well, they connect a very segmented market, which is suppliers of parts, suppliers, and what do these it's in industry, heavy industries, heavy manufacturing. So let's say you are a large manufacturing company, you want to get a part made, you want to get some die casting done, some 3D printing, some tube bending, some sheet metal done. You're in a development office, you work with SolidWorks, you work with AutoCAD. In these apps for 3D industrial design, oftentimes you can say order part, and when you do order part, well, you could have your own suppliers set up in the system, but you could also have Xometry set up in your AutoCAD, and then you say, okay, well, I've just designed this part, let's get it ordered, right, for my prototyping work or for my factory, my plant, whatever. Historically, it is small shops that have only had 1 or 2 customers that do these parts, and now it is changing where these small shops can create parts, print parts, CNC parts for all sorts of large businesses all over the USA and eventually all over the world, and the pricing differs based on the rating of the specialist, the small business that does that, based on their location, based on how quickly they can do the part, based on shipping. That's what changes. But it's a marketplace to connect buyers, usually large players, large companies in manufacturing, to suppliers, usually segmented shops, small segmented shops that make these injection moldings, finishing, castings, all sorts of stuff. That's the business model. Of course, the theme today on this is manufacturing, the return of manufacturing to the USA. That's one of the big themes, and eventually Europe and other places of the world, of course. And they're actually expanding. I didn't put that slide here, but they're actually expanding to Asia as well, which would be very interesting if you can get just a US manufacturer, get parts manufactured in Asia and FedExed over here really quickly. That could also be a major play. Let me just get to the numbers so you can see this company is still growing, albeit slowly. But what I'm used to in companies covering our channel, revenue growth is predicted to be 19% over the next 12 months. The gross margin is 39%. So again, a little smaller than what I'm used to on the channel. But it's a network business. Network businesses are expensive. This is something I've witnessed for a while. I think what's important to note, though, in the case of Xometry, is that they are guiding, let's call it 2 million and a half EBITDA loss. And of course, that's an inflection point type of investing here, because give it a few quarters, they won't be losing anymore. They will be making EBITDA, right? So that's your proxy for cash flow. And at maybe 2 quarters, and they'll be starting to make a profit. And this is usually when a lot of investors wake up to an opportunity, is when a company gets GAAP profitable. Keeping that into account, I think it's an opportunity to get in early into a stock. So that's why I'm looking at this stock. I don't look at this stock. This is no advice, but I'm looking into the stock. This is the number I want to show, right? They are losing about let's even assume they lose 5 million this coming quarter, and another 5 million. Look at how much cash they have on balance sheet, right? They can operate like this for a very long time with 241 million in the balance sheet, and the operating leverage is going to kick in. And for businesses like that, it's about finding that balance, right? It's like, how do you balance growth and then profitability? Well, to me, this is a business that is not in a hurry to be profitable, because they can finance their growth by making less money for now in exchange for growth. They got to go for growth to capture that giant market opportunity, in my view. And the stock, of course, is way down. It is down 46%. So 46, whatever. It's down about 50% compared to where it was 6 months ago. So in my view, this stock is a deal. But of course, this is no advice, no investment advice, no financial advice. This is just entertainment. So I hope you were entertained. I hope these stocks give you an idea of what I'm looking at right now. Please like this zero financial advice, no financial advice video. Please subscribe. And this video, as all of my videos, is brought to you by my supporters on Patreon. They are responsible for not responsible, but they sponsor every video I do, and they're the main reason why I'm keeping going with this channel. And of course, I provide all of my premium content on the Patreon, and the Patreon is cementing the durability of the channel. So thank you so much for those who wish to support me as a creator. No financial advice. I've said that 5 times. You probably know by now. So thanks for watching. Have a wonderful day.